the thing that upsets the whole system, of course, is when the general public decide that they want to buy gold or they want to buy silver, which they do generally through ETFs. And particularly with silver, if you look at the ETF storage in London, it's something like 80% of, or it accounts for something like 80% of the silver stored in the LBMA vaults. The other 20% is owned by others and includes some liquidity, perhaps, if you're lucky. So you can see that if, let us say, the general public decides we're going to buy some silver, which means that the ETFs go into the market and increase that proportion, if you like, of their silver in the London vaulting system, the squeeze is a short answer. I mean, there's still a backwardation. There's still a backwardation in silver.
Mhm.
I mean, okay, it's not as extreme as it was, but and if you look at gold, I mean, gold never went into backwardation, but I think that's been better handled, if you like, by the establishment. The establishment now knows that gold is rising. I mean, if you want evidence of this, the LBMA's annual meeting, which was a week or two ago. I mean, they do what they always do. They ask all the attendees, what's your forecast for the price of gold and for the price of silver and all the rest of it, in 2026. And the average of all those expectations came out at just under $5,000. What that tells me is that the bullion banks, the refiners, and the various other members of the LBMA do understand that gold prices are going higher. Now, we needn't discuss whether they actually know what they're talking about in economic terms. I mean, we can only guess at that. But I think that behind this, there is a greater acknowledgement, if you like, that there are going to be supply difficulties when it comes to physical metal, for the simple reason that what happened earlier this year, when the trucks were queuing up outside the Bank of England to take gold out of the vaults and ship it over to COMEX. This, I think, quite clearly signaled to the central banks, who basically store, I mean, all the gold in the Bank of England basically is central bank gold. I mean, a lot of it is leased. So technically it is actually owned by others, by non-central banks. But this is under lease. Now, the way in which this has worked in the past is quite simple. Bank of England turns around to, say, the Bank of Austria or whatever, and says, we can lease your gold. It'll earn you income. You'll earn 1.25% on it, whatever, which means that you will make a profit. It'll pay for all your costs of storage and all the rest of it. And it will be done by book entry transfer so that it remains in the bank, in the bank's vaults. And of course, it's got to be stored somewhere, so there's no point in taking it out of the bank's vaults. What it has meant is that it has provided liquidity for the London market in particular, where it's been hypothecated, rehypothecated, re-rehypothecated over the life of the lease. And of course, at the end of the lease, it hasn't been a problem because the bank could easily persuade the Bank of Austria to extend the lease, or alternatively find someone else to provide a new lease.
Mm-hmm.
But now all the central banks have been put on notice that if you lease your gold, you might lose it. Do you see what I mean? So I think the liquidity issue in London is actually very much in the back of the minds, if you like, of the bullion banks and the LBMA membership in terms of future liquidity. They are not short, and they are not short for that reason. I don't know that they're properly long. I don't think they are necessarily, because quite a lot of their long position, I think, will be with other paper. For example, through forward contracts. They would have bought forward, or alternatively, they would have taken out option positions and sort of capped their potential losses.
Mm-hmm.
And on top of that, of course, you have unallocated accounts. I would guess that the unallocated accounts are not properly covered. I think if you have a sort of rule of thumb that an unallocated account is probably only backed by 10% of gold. But as far as the bank's books is concerned, other than the unallocated accounts, I'm sure that the banks in London are long. And but they've got to stay that way. And they realize the constraints, if you like. I think this is really what's going on in gold. The thing that upsets the whole system, of course, is when the general public decide that they want to buy gold or they want to buy silver, which they do generally through ETFs. And particularly with silver, if you look at the ETF storage in London, it's something like 80% of, or it accounts for something like 80% of the silver stored in the LBMA vaults. The other 20% is owned by others and includes some liquidity, perhaps, if you're lucky. So you can see that if, let us say, the general public decides we're going to buy some silver, which means that the ETFs go into the market and increase that proportion, if you like, of their silver in the London vaulting system. The squeeze is the Chinese authorities' approach to silver. I mean, in the past, they've basically accumulated silver. They have controlled the price. I mean, the suppression of the silver price, I put down to the Chinese. I mean, I think in 2023, they supplied, I can't remember the figures, but I mean, something like 200 million ounces or something, figure like that to the West. And the interesting thing was that they supplied it to London, they supplied it to Hong Kong, they supplied it to Singapore, and I think there was somewhere else. I mean, these are all financial centers. These are not manufacturers. In 2024, the financial centers came out of it, and it was supplied more to, countries like India, who manufacture solar panels and all the rest of it. I think it's probably stopped now. And if you look at the Shanghai Futures Exchange, the vaulted silver there has dropped very substantially. I'm told that the view is that if it goes down close to 500 million ounces, then we've got real trouble. Well, it's going that way. So and interestingly, I mean, we wake up in the morning here in Europe and find that gold and silver are going better during Hong Kong's trading hours or Shanghai's trading hours. And we're trying to put a lid on it. That, as you can see today, I mean, we were up to what on gold we were up to what 4,020, and this afternoon, guess what? It's drifted back to something like 3,980. So the sellers, and they're not serious sellers at all. I think they're managers, if you like, rather than sellers. Managed to get it done by something like $40 off the top. We'll see what happens overnight again. I mean, there may be a bit of profit taking because obviously ahead of the weekend, the Chinese are wild punters too. I mean, when it comes to futures and things like that, they may well take some profits ahead of the weekend. So we might see some more weakness tomorrow. I don't know. But the underlying situation is that the stuff is running out of the vaults, and sooner or later, there's going to be a huge great conflict between the physical market and the paper market. The problem really with assessing what China owns is that they're very secretive about what they have bought. If you like, and I don't know the answer. I really don't know the answer. So what I've done is I've tried to work out on the information that we have what the answer is likely to be. My starting point in this was that the regulations appointing the People's Bank of China with the sole responsibility for acquiring the nation's gold and silver date from 1983. Now, it was at that time, Mao died in 79 or thereabouts. There was a massive inward investment going into China. And certainly from the